Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. This week, I don't get to say we're coming to you from sunny Coachella Valley. In fact, winter has finally arrived here in Palm Springs and the greater Coachella Valley. The rain in Southern California has even come over the mountain onto our side. And we've had a pretty consistent rain all day. But yet we're grateful for the fact that it hasn't been an inundation of a lot of rain that, of course, in the desert areas, as you know, can cause some pretty dramatic flooding. So, knock on wood, we haven't seen that too much of that yet. So again, welcome to this week's Mortgage Minute. As you know, we like to start the program with giving you a quick update on mortgage rates. And I think it's relatively good news. I'll talk more a little bit about what the financial markets did this week. But when you go to our website, there's the rate grid right on the homepage. And you can see that we're still holding steady, getting to be kind of a broken record. We're holding steady in the mid sixes, conforming loans right around 6.5, FHA, VA just at 6 or a tad higher. 15 years are back under 6%, and even the jumbos are, relatively good, low to mid sixes. Keep particular focus on those equity loans at the bottom, the HELOCs and the HELoan rates. We've been getting an uptake in HELoans. Those are the fixed rate seconds. Those are priced pretty well right now relative to all the other options that homeowners have for pulling cash out of their cash equity out of their property. So if anybody's interested in looking at that, please call me and I'd be happy to give you some numbers. And again, don't forget to look at that tab at the bottom about mortgage rates. Goes into some detail. We have a video there where I explain how mortgage rates are determined from day to day. So in terms of the financial markets, let's kind of take a look at what happened this week. There's the rate grid that Jeff just pulled up. It's a 5-day chart going back to last Friday to today. And you see that kind of a big jump yesterday, which, of course, that kind of goes against what Jeff theorized in previous programs where he felt like he saw a pattern of bond yields dipping on Wednesdays. Well, yesterday, that wasn't the case. It actually jumped up quite a bit, almost 1/8%. So that's a good example of what we like to say. As you know, financial markets can often respond with reptilian-like minds to stimuli. And so what's going on this week in terms of data and data points that cause this kind of reaction in the market? Well, this week, of course, Tuesday and yesterday, Fed Chairman Powell testified before Congress. And his message is consistent. We've talked about this before. They're going to be more cautious about inflation risks. They're in no hurry to lower the Fed funds rate further. There was even a suggestion that maybe there won't be any rate cuts in 2025. And again, remember, people, when we're talking about rate cuts by the Fed, we're talking about one rate, the Fed funds rate. But yeah, it's on the table now in the financial market, some discussion. There may not be any Fed rate cuts at all this year. And then, of course, Chairman Powell also pointed out that even though CPI and PPI came out this week, they're really more focused on the PCE. That's the Personal Consumption Expenditures Index. That doesn't come out till next week. The Fed thinks that's a better measure of price pressure, and obviously that means inflation. So that's really what they focus on more than the CPI and PPI. But CPI and PPI did come out this week. CPI, Consumer Price Index, that came out yesterday. It was, as they say, hotter than forecast. That's what caused that big jump on that 10-year bond chart that Jeff showed you earlier. The market reacted very strongly, both the stock and the bond market, thinking, oh my gosh, inflation's back. We don't have it under control. And so as a consequence, you saw that big jump in the bond yield, again, over 10 basis points yesterday. And the core CPI year over year, based on the release yesterday, shows inflation at a 3.3% clip. Again, the target is 2%, so we're ways away from that. And that's, again, why the markets reacted the way they did. Now, today, the producer price index came out. That's inflation at a retail level. At a wholesale level. And that came in slightly higher as well, but below what it was last month. And so, believe it or not, today's PPI number helped relieve the market. In fact, we call that a relief rally. So you saw an improvement in the stock market. Stock market was up today, and that 10-year bond yield dropped almost that full 10, 11, 12 basis points that it went up yesterday. It came back all the way today, almost to where it started before yesterday. So again, a very quick, immediate overreaction yesterday, and then things are calming down today. The only other big number coming out for this week is going to be retail sales. That comes out tomorrow. And remember, it wasn't too long ago, a really strong retail sales number really caused the bond yields to jump up quite a bit. So we'll see what happens there. Again, retail sales is a big part of the economy, services and so forth, about 70% of the economy. So a strong retail sales number will not be good for bond yields and could affect mortgage rates to the negative. But I continue to believe we're going to be in these levels for an extended period of time. And again, I think I mentioned last week, don't forget, Fannie Mae is projecting that at the end of this year, 2025, the conforming loan rate is going to be, guess what, 6.5%, right where we are today. So if that's the case, if nothing else, that means we're going to be at this level, higher for longer, but it may be a relatively stable period, which I think overall ultimately is going to be good for the housing market. So with that, that's your update on the market and mortgage rates. We're going to bring Jeff back because we got a few other things to talk about.
Art, I'm hesitant to jump in here because now my Wednesday drop theory is definitely out the window with that spike we saw yesterday.
Yeah, at least this week.
Yeah, it's just that's a tough one to forecast. I guess I could have muckied with that, but I figure I better not.
I know.
I'm interested in this whole idea of, you said, hey, the rates are going to be forecast to be at 6.5 by the end of the year. It seems like, that's a sign of real stability. And it's always one of those things. It's like, this is me personally, and I think for a lot of people, they would rather make decisions based on stability than instability, because you just don't know if you're going to be good or bad. And it seems like that the fact that the rates are holding steady, they have been for a while, like you said, it's kind of like a broken record, which is not a bad thing. What's your thoughts on that?
Well, I think it's exactly right. Stability is a friend of prospective home buyers, of homeowners, borrowers, somebody who's looking at sometime in the near future needing to borrow money. And where people get really anxious and can get very nervous is when you have a lot of volatility, especially like if you're buying a home, and you can get really wrapped up in like things like you're starting a purchase transaction and you've got to get financing, you're going to apply for the loan, and then it's like, oh my gosh, I've got to make a decision on the rate lock. And that can really drive some homeowners or some home buyers crazy, because they start asking a lot of questions, and of course they want me to predict the future and tell them should I lock the rate or not. And it can be very nerve-wracking. And I try to tell people, when it comes to getting a mortgage and making the rate lock decision, you got to think about it like you're buying stock. You've been eyeing a particular stock, you think it's a good investment, you want to go ahead and strike a buy, but you got to decide when to do that and at what price. And once you do that, make that purchase, you got to just move forward, don't look back, and don't second guess your decision. And when it comes to mortgage rates and locking in your rate, I think you got to take the same approach. Plus, if we're going to have a very stable interest rate market for the better part of this year, which I'm in that camp, I believe that's going to be the case, barring some very unusual, shock to the financial system, and that's often caused by a world event or something. If that doesn't happen, we have that stable market. To me, that underscores even more the benefit of, if you're going to get a loan, a purchase loan or even a refi, don't mess around with the rate lock decision. Lock it in at time of application. You're protecting your upside. You're not going to see anything worse. But if the market gets better, as we've talked on the show before, most every lender we deliver loans to have a renegotiation of your rate lock option. There's certain parameters you have to meet, but that way it gives you that opportunity for that one-sided bet. Lock in your worst case. You still have an opportunity to get a better rate before you close if the market does take a dip. And so that way you can take advantage of it.
One thing I want to touch on, because it just, this is a live show. Things are happening right now, and something happened with some of your content that, you mentioned a few weeks ago, and you've mentioned it. You've shared that over the course of your show, but it was really evident when we talked about how wealth building, is really tied directly to home ownership.
Right.
And, you had a video that you did a while back, just a few weeks ago, that it literally outperformed. Not that your videos don't do well, but this video outperformed by about 40x. And it was about, if you really want to think about wealth building, you really need to be thinking about being a homeowner. What's your thoughts on that?
Well, I think that's exactly right. As you said, we covered it not long ago, and part of the reason we did that, I had attended a presentation by Jordan Levine, who is the economist with the California Association of Realtors, and that was a big point he made to this audience of a couple hundred realtors and affiliate members in the real estate industry about the fact that for the majority of the population, not just nationally, but here locally in California, there is clear data that supports the fact that if you want to build wealth, probably, no, not probably, it is true that the best pathway to build wealth is to get into home ownership. Now and if you recall, Jeff, when we covered that a few weeks ago, and we actually got a reply from one of the viewers who kind of pushed back on that and pointed out that he bought a home some number of years ago and he sold it a couple of years later, and he made I don't know, it was like not a modest gain of 30,000-40,000, but he was a renter ever since. And of course he touted the fact that over that period of time, since he no longer owned that home, he sold it, he had built some financial assets. Of course, my response to him was, first of all, I gave him kudos for doing that, but I also pointed out to him that the data shows he's the exception. That most folks who are renters, and we touched on this, the challenge is, and the argument is, you stay being a renter. If you have good income, you can build assets, build wealth in an alternative way, alternative investments besides home ownership. Totally understand and accept that. I agree with that. But there's this one little problem. It's called human behavior. and the other little problem, it's called discipline. And so if you're a young person or a young couple, and you could be a young person making $150,000 a year, which, by the way, I see a lot of this notion that there's not a lot of money out there, that I think is a little off. Or a young couple, and between the two of them, they're making $250,000 a year. Do you have to buy a home to gain that wealth creation? No, but you have to be very disciplined about, with that kind of income, how you're going to allocate your dollars in terms of spending. And what the data shows is a majority of those folks who are fortunate to be in that position in terms of their income don't have the discipline and the focus on allocating those dollars in a way to build wealth. As we said in the show a few weeks ago, they buy nicer clothes, and they drive a fancy car with a $1,500 a month payment, or they go out to dinner all the time, or they're ordering dinner in all the time. And I don't get that. I mean, I've never understood why you would order dinner and have it delivered with DoorDash or Uber Eats or whatever. And the extra cost to do that is like, my gosh, jump in the car and go pick it up yourself. If nothing else, just to get up off your butt and walk around a little bit, walk into the store, pick it up, and go home. Anyway, I digress. But the point of it is that too many renters, that's what the problem is. They don't get to that wealth creation destination because they don't have the focus and discipline to achieve that through another means besides home ownership. So if that's the case, and if you still need shelter and housing, why not accomplish both goals by using that income and buy the house? In fact, there was an article that came out just this past week that focused on a young couple who were making over a couple $100,000 a year. And it was a woe is me, I can't afford to buy a house type of an article. I think Jeff, I'll talk to you more about it later, but I think I want to cover that article next week. Okay. Because there were so many things said and quotes in that article that I felt like basically underscore what we're talking about right now. Because again, it's a real issue. And I think renters need to pay attention. If you want to build wealth, get off the fence and look to buy a home. It's going to pay off handsomely in the future.
Yeah, I think that's so true. You talk about the younger people of today, and we were out to dinner on Monday evening with some friends, and they have adult children, and they were talking about, hey, what's going, kind of catch with the kids because we've known them since they were babies. And they said, "Oh yeah, Michael is going to a wedding in Greece, and then he's going to one in Vietnam." And I'm like, "What?" Like, I turned to my friend. I said, "When you were a kid," I said, "did you ever think about going to someone's wedding that's in a foreign country or even out of state?" And he laughed. He says, "No, I never did." He said, "But these kids think differently today, right?"
Well, they
And
do. I mean, Jeff, you and I are old guys, but I mean, the best I could do to go to a wedding was at the local country club down the street. I mean, and even then it could be a challenge because, gosh, I had to put on something nice, and then maybe I didn't have that, but I had a old sport coat with a repair in it or something. But you're right. I think and you start to sound like an old fuddy duddy when you talk about this. But yeah, I mean the younger generation, I think they have different priorities sometimes, and maybe more of a focus on life experiences.
Mhm.
And I get that, but it's like you got to kind of figure out in life when to take advantage of those opportunities and when to focus on other things first, so that maybe you can enjoy more of those life experiences maybe a little bit later. Just postpone it a little bit. Get your shelter in the form of owning a home rather than renting an apartment. Start building your wealth, and if you maintain your income level, and if you're a pretty good saver, it means pay attention to Dave Ramsey, right? Then you may still have plenty of time to do some of those other things that are more in the life experience category. That's going to be memorable and going to make a difference in your life. Certainly, I'm not disputing that, but it's all a question of when do you start doing that versus when do you start, building your foundation first from a financial standpoint, and then still have plenty of time to do those other fun things.
Yeah, it feels like the one things for myself and my wife is like our home became a forced savings account. We just that's kind of what it became because
Yeah.
as you can attest to over the 4+ decades you've been in this business is it's rare that our value of our home ever goes down. And
It-
not that it doesn't, but if you take care of it and you buy in a decent area, the chances of it going up are probably more in your favor.
right.
Um,
Yeah, that's
so
exactly right. And of course, everyone remembers '08, so that's the buggy boat. Oh no, don't forget '08. That could happen again. Yeah, it could. But frankly, I mean, folks who owned a home right before that crash, and if you're able to hang on and work through that and keep that home, eventually, guess what happened? Values came back to where they were pre '08, and frankly, by 19 and going into the pandemic years, blew right past those values.
mhm.
We're much higher in home values now than we were, at that precipice of 2006, 2007 before that crash. So it will come back. You just got to do the right things financially to kind of weather through those periods.
Yeah. All right. Well, let's jump into today's topic because I just wanted to kind of rehash some of those things because I thought they were so important and again timely for our conversation. But it's always on the mind of people is like, should I buy a home in 2025? And so I thought let's have a little bit more of a discussion on that. But I don't want to get into this too far until we talk about something we kind of started talking about last week, but I unintentionally glossed over it, and I want you to take a second and talk about it. And it's the Cal Vet loan
Oh yeah.
program that's going on because we talk about how the vets really, only was it like 13%, I believe you said, actually take advantage of their VA loans. But then you said, but Jeff, there's a Cal Vet loan program. Tell us about that.
Right. Yeah. Right. Exactly, Jeff. Yeah. We talked about last week that only 13% of eligible veterans had ever used their VA home loan entitlement, and fully one-third of eligible veterans uh, who have the ability to get a VA loan aren't even aware of the benefit. And so, as we discussed that, I wanted to bring up the fact that another, even more uh, almost unknown option for veteran borrowers is CalVet. Now, what is CalVet? CalVet is the California Department of Veteran Affairs. Believe it or not, it's a state agency, and it's been around for over 100 years. It was created in May 30th, 1921. And it is a state agency that provides mortgage loan financing for veterans. And it's not well known. It's not a product that you hear much about, and yet it is a terrific product. And there's some interesting niches. VA loans don't have a credit score, but most lenders who provide VA loans have what we call an overlay on your credit score, a minimum credit score requirement. Calvet loans don't have a minimum credit score, and they don't have any overlay. They're a state agency. So if you have a bit of a challenge on your credit score and you have a VA home loan entitlement, Calvet is a great option. The other thing about Calvet loans is the interest rates on these are not market driven. These are the rates provided or offered are based on bonds, on bonds being sold in the financial markets. So the rates offered are much more stable. You don't see the day-to-day jumping around in terms of the rate possible or available like you do with a standard VA loan, which is driven more by the financial markets in terms of government National Mortgage Association bonds. The other thing is with a Calvet loan, if you already have an existing VA loan somewhere, maybe you've moved out of that house, but that loan is still existing, you can use a Calvet loan and use your remaining partial entitlement to buy another home. So essentially, you can get a Calvet loan behind an existing VA loan that may be secured by a property that you since sold, but that loan wasn't paid off. Because remember, to get your VA home loan entitlement back, you've got to have the house that was secured by that loan, or the loan secured by that house has to have been sold, and that loan had to be paid off. The other thing about Calvet, which is really cool for Riverside County, is the loan amount for Calvet loans can be up to 125% of the conforming limit. Well, the conforming limit in Riverside County is 806,500. 125% means you can get a Calvet loan for $1,008,825. So just over $1 million, you can get a Calvet loan. Calvet has a down payment assistance program. Now, it's not actually down payment assistance. They call it DPA. It's 3%, but it has to be used toward closing costs. So with a Calvet loan, you can get a zero down payment loan, and you can get a 3% DPA help to pay your closing costs. Again, a very unique feature of Calvet that you don't see with the VA loan, the standard VA loans. VA loans don't have, Calvet loans, I should say, have no junk fees. There's no lender fees involved. Of course, at MortgageWorks, we don't charge any fees. We never have. So you have much less in the way of fees other than the standard appraisal, credit report, escrow, and title. And then the most important thing about Calvet loans, the rates are terrific. 5.49% is the current rate offered for a Calvet loan. A VA loan's around 6 to 6 1/8. So you're going to get about a 0.5% better rate on a Calvet loan versus a standard VA loan. Now, why do a lot of lenders not offer this, or mortgage brokers like us not offer this? Well, in part because a lot of lenders just aren't aware of it. And I think the more important issue is, if we're going to arrange one of these, we get paid a flat 1%. For a lot of loan brokers, as we've talked about in the past, where we get paid by the lender, a lot of mortgage brokers we compete with require from their lenders that they get paid a higher percentage of the loan amount. You already know, our viewers, that we don't do that. We tend to be at 1% with most of our loan programs. So being paid 1% for a Calvet loan is fine. That's right within our policy anyway. So I'm happy to originate a Calvet loan for an eligible veteran and take that 1% fee as our compensation. We're paid by the state agency. We're not paid by you. And that really can help you in terms of get that better rate that the Calvet offers. So I just want, Jeff, everyone to be aware of this program. If you're a veteran with a home loan entitlement, call me. I can go over both options, the standard VA or the Calvet, and help you choose what's going to be best for you.
I mean, Art, that's just amazing.
Yeah.
The rates you're quoting and the fact that there's no credit limit on that. Is that how I understood that?
Credit score.
Credit score.
No minimum credit score. Yeah.
That's amazing. And I love the fact that, as you say, hey, if you haven't used all of your VA entitlement, you can then also use it with the Calvet for a second property, for another property, if you move out of that and it didn't get paid off. I just think that's fantastic. And as you say, it's not something that was developed overnight. It's been around for over 100 years. That's wild.
I know.
And why? So I know you kind of touched on it. Why isn't that more readily spoken to? Like, we've done this for a while, and this is the first time you really talked about Well, it's only the second time you talked about Calvet. Is it?
Why is that? Why is it not?
Yeah, do we just not have that many? I know it's only 13%, but do we just have that many vets that are coming in buying homes that they're not even aware of it?
Well, yeah, I mean, I think part of it, a lot of it has to do with, well, I got to be a little careful here because I don't want to sound too critical of the real estate industry. But I think there's a fair amount of old thinking out there
Mm.
among real estate agents and brokers in terms of awareness of the standard VA product and probably even CalVet loans. There's this mystique about VA loans that it's government and it's takes longer to get. They're more picky, in particular, on the appraisal and
Mm.
repair requirements. And then there's this concept called non-allowable fees, where certain fees in a transaction are not allowed to be paid by the veteran borrower, and so as a consequence, the seller is forced to pay them, such as the escrow fee.
Mm.
But those most all of that is a myth. On non-allowable fees, when we originate a VA loan where there's no origination fee, no points to the veteran, the non-allowable fees can still be paid by the veteran as long as they don't amount to more than 1% of their loan amount. But
Ah.
guess what? In almost every transaction, that test is met. And so the seller doesn't have to pay the non-allowable fees. And that buyer can still use a VA home loan benefit and pay those non-allowable fees because they're all within the 1% limit on their loan amount. The other thing, and I actually, again, I was at the CAR winter meetings last week. I actually heard a realtor talk about how agents, if they get a VA offer, they'll basically either ignore it or they'll counter and say we'll accept your offer, but we don't want a VA loan because they just think it's going to take too long and they're going to get beat up on repair requirements on the house and because of the appraisal. And again, I mean, there's some of that goes on, but I don't think enough to warrant preventing eligible veteran borrowers to take advantage of what is really, I think, one of the best home loan programs in this country.
Mm.
It's really kind of shameful that we don't do a better job as an industry to make this option available to those who have the benefit. And again, many times they don't even know they have it.
Wow.
We'll get right back to today's program, but first, I want to share something that could be incredibly valuable for senior homeowners. If you're over 65, own your home outright, or have at least 50% equity, you might be sitting on a powerful retirement tool, a reverse mortgage. But how do you know if it's the right move for you? That's where our free Senior Homeowner's Guide to Financial Freedom comes in. In just a few quick questions, you'll find out if a reverse mortgage could help you unlock the equity in your home to boost your retirement income. Click the link in the description to take the free assessment today. It's fast, easy, and could be the first step to a more secure retirement. Now, let's get back to the show.
Well, it's when it comes to the market in general. You shared an article with me about, the U.S. housing faces historical decline, and what's wild is we think of the historical decline was really in the '08 market, right? And that was pretty historical. What is this? What is this referring to now?
Well, the article was referring to the fact that, yeah, we have this alleged historical decline. And mind you, this was a article in a trade publication, focused on the mortgage industry. That's the audience. But one of the things it was talking about, of course, it was comparing, like if you bought a $400,000 home during the pandemic where it was, the interest rate was 3%. There it is right there in 2019, I should say, at 3.5%. Of course, if you buy a home now at 500,000, the rate's double that, your payment's so much higher, about double what it would be. So it's like with those conditions, here's where this historical decline is coming in. And so it goes on to talk about how, and I'm in the business, so I know, I mean, mortgage applications down, 2/3 since the peak of the pandemic. Guess what, folks? That's true. We're living through that now. But at the same time, doors are open. We're still doing loans. Not as many as we were, but it's not like the bottom has fallen out, but it's obviously much more depressed. Here's the real number that I think got my attention, and I keep talking about this: home prices. I think home prices are the issue more than mortgage rates, because mortgage rates historically are not that bad. The real culprit here is home prices, 80% higher than long-term averages. I mean, when you look at that, and then again with that number, the article points out that on an inflation adjusted basis, housing prices, higher than they have been in 134 years. I mean, that is, I mean, none of us could even imagine what the inflation adjusted housing cost was 134 years ago in the 1800s. But that's a dramatic, and that kind of gets your attention, and it can really be a kind of make you feel kind of down in the dumps about how bad the housing market is, which is always a concern. I'm glad this was an industry focused article and not just out there on Washington Post or something. But and then of course it points out that what kind of income do you need to buy the median priced house, 115,000. So all of that, pretty bad news, and it really kind of gets you down, and it just doesn't give you much room for hope, right? So then after seeing that, of course, I ended up seeing another article that was talking about what's going on. Well, it actually talked about a Fannie Mae survey. What's going on with the Fannie Mae survey? Well, it was very interesting in my mind, because what the Fannie Mae survey, I think, illustrated was, I think I've called it recently the prospective home buyer capitulation in terms of where we're at with home prices and mortgage rates. What the survey showed is that a lower number of people, prospective home buyers, the public, are expecting mortgage rates to drop. I think that's a good sign. It also pointed out that actually there's a larger percentage of people who actually think mortgage rates could go up further. 32%. I think previously it was 25%. So you've got less people thinking rates are going to drop, and a little bit more people thinking rates are going to go up. And so when you see that, you're kind of like, wow, that's interesting. The other thing that the survey pointed out is a good portion of the respondents, I think it was 43%, think home prices are going to go up. What have we been talking about for quite a while, Jeff? Rates are going to stay higher for longer, and home prices, despite these higher rates, are going to continue to trend upwards. And so you take all of that data in this article from the Fannie Mae survey, and then here's the big surprise. A slightly higher percentage of the respondents are actually more optimistic about a home purchase in the near future, in the next 12 months. So it's like, so in my mind, you put these two articles together. On the one hand, it's like the world is coming to an end as to the housing market. Fannie Mae, I think their survey is giving us a glimmer of hope that the home buying public, the prospective home buying public, is starting to come around to realizing, okay, we've waited long enough. Home prices are going to keep going up. Yeah, it looks like rates are not dropping anytime soon. And gee whiz, we're a renter. We're not building any wealth. Gosh darn it, we need to figure out a way to get in the game now and take advantage of home ownership, despite these conditions that otherwise might make you feel like it's hopeless. And we're seeing some evidence of that, and, certainly in our market here. And I heard a lot of it in the winter meetings last week from people in the other parts of the country. There seems to be a little bit more activity on the buyer side. More people out there going to open houses. Not that we're in a multiple offer situation with most listings, but there's just more activity, and I'm seeing it with our own business in terms of buyers. They're getting out there more, they're taking a look more, and I think that's a pretty good sign. So ultimately, I think we're on the right track. Things are going to get better. It's going to be slow. It's not like we're going to just bust open and have, a ton of new applications and a bunch more home sales, but I think we're going to trend upward. It's going to be a better year in 25 than 24.
Well, I was curious about that. When you talk about the prices and getting off the sidelines, the fact that you've been doing what you've been doing so long, are you able to detect some common signs in a market when it starts to shift? Because you've said this before, it's Econ 101, supply and demand. And we're starting to see, as you pointed out, we're starting to see some more homes come on the market. The inventories are going up a little bit. They're on the market a little bit longer. And so are those partially signs that, hey, this is becoming an opportunity for those people who have been on the sideline? And again, the stability of the interest rates?
Yeah, I mean, and I would say it's not just partially a sign. Those are very good signs. When you start to see the days on market creep up, when you start to see the inventory is finally away from that ridiculous 1.5 month supply
Mhm.
based on the sales rate, and we're at least getting into a much more healthier 3 to 4 months, 3.5 to 4 months. Again, we're not back to the historically typical 6 months, but we're certainly a lot closer to that than we were. And then as the data shows and the viewers on this program and where they see elsewhere, mortgage rates really have kind of settled into a relatively narrow range where you're not seeing these, very abrupt, steep movements either way. And I think that creates a little more certainty. It kind of lowers the anxiety level of people who are going to go out looking for a home, that they're not going to be scared of, oh my God, we got to hurry up because the rate could go to 8%. So I think you put all that together, here in our local market at the Palm Springs weekly caravan meeting, the number of homes on the caravan have been substantially higher.
Oh.
All this, it's only a month and a half into the new year, but we're looking at 35, 40, 45 homes on the caravan now every week. And I think that's a good sign. I mean, that means more inventory. But the nice thing about it is the agents who have those listings are saying when they're holding open houses, not just to the brokers, but on the weekends for the public, they're seeing more traffic. Now, that doesn't mean every one of them's like throwing an offer at them, but just the fact that they're seeing a lot more traffic is a healthy sign. And I think that eventually will lead to more transactions. And that is the prediction, that we'll probably see maybe a 10% plus increase in transactions for the year.
So your overall sentiment then is pretty positive.
It is. And I'm seeing it again in our business. We're getting more calls, more requests from agents for pre-quals. We're getting now more inquiries too for equity loans. Those are already doing relatively well compared to the purchase market and certainly first mortgage refis. So on balance in all segments, we are seeing more inquiries, more requests, and asking for more information. I met with another prospective home buyer couple yesterday to help them determine if they can qualify. And of course, I was able to determine, they were paying almost $4,000 a month rent.
Wow.
And, the price level they were thinking about for a city here in the local valley, 600 to 700 plus. Well, guess what? They do have some money in the bank, and I can end up getting a finance at current rates with a monthly housing expense that's slightly above what they're paying for rent. Like,
Wow.
in the 42 to 4,500 range, if they're paying $39.50 for rent, do the math with the tax benefit of the mortgage interest deduction, and it's like, that's a no-brainer.
Yeah.
Time to go find that house.
Yeah,
So
no kidding. Well, you mentioned something about the equity, but there is a certain group out there of homeowners that, in fact, it's about 71% with the information you shared that are concerned about their future, and I just want to bring that up. And it's the 70% of American seniors, and I think that 71% refer to, hey, they're not so certain about their financial future. Talk to us about that and what the good news is for that 71% of seniors.
yeah, exactly. In fact, what I'm seeing, and there's a particular segment that I see more evidence of, and that's the senior homeowner who's 55, like between that 55 to 62 or 55 to 65 range. Many of them own a home, right? They have a lot of equity because they refied in 20 or 21. They want to tap into that equity, but there may have been a change in their financial situation. Maybe their income's not quite at what it was. They're getting ready for retirement. They're not quite there yet. They want to tap into that equity, but they're running into some issues in terms of qualifying for pulling that cash out, like a typical home equity line of credit, a HELOC, or what we call a HE loan, a fixed rate second. So there is a good segment of those people who have a need, and it's not being met with a traditional loan product. What we talked about it on the show some time ago. I wanted to bring it up again. We have a product called Home Safe Second. It is a second mortgage, but it is a reverse mortgage type of a product. The benefit of it is you can get this loan as a second loan, and you don't have to make payments. You can if you want. Can't stress that enough. You can make the payment, so you have the flexibility of making it or not when you have the ability to do so. And it's much easier to qualify for. I've done a few where somebody couldn't get a HELOC. They couldn't qualify for the criteria. With this product, they were able to easily be qualified because the approach is entirely different. It's not based on debt ratio. The credit score limit is much lower at 600. So this is a great product for people running into that problem. And there's all kinds of reasons why this is a good product for that kind of homeowner profile. And we're going to list them here for you. The very first one is a line of credit that's maturing. If you had a line of credit, maybe you got it 10 years ago, it's maturing. It's the interest only draw period's over. It's going to amortize fully for another 20 years. And you look to get another one, you don't qualify. This is a very good reason to look at a home safe second. Another one might be maybe you're looking into you're starting to have some health issues. You may have to modify your home for accessibility improvements. This is a great option to get the cash to do that. And again, having the flexibility of making a payment on that loan or not. Another one is you may have a big lot. You want to generate some additional income, or you may want to have housing for a family member. Build an ADU. This is a great way to pull that equity out, build that ADU, and again, have the flexibility of making a payment on that loan that you use to build the ADU or not. You may have a passion project. You're getting close to retirement. You want to use your retirement years to focus on something that's your passion in terms of a hobby or maybe some kind of side hustle or business. This could be a way to get the startup funds to do that. Again, something that a lot of folks don't even think about, but it's a great way to get that done. Another one is you got grandkids. Family is looking at you to help out with tuition. Not a better way to do that maybe than with this product. And again, not having to make those payments. Or the other thing, if not the grandchildren, your children, of course, your children could be 38 years old, because we talk about the first time home buyer now is 38 years old, average age. They may need help with a down payment. So you can use this program to pull that cash out to help your kid, your adult kid, buy a home. So this is used quite often with the Home Safe Second product. You may have debt yourself. And this we run into a lot. It's kind of scary, actually. 55, 58, 60-year-old homeowner, and things change with their job. Maybe they're working less hours, had an income cut, and they've been living off credit cards, and they're getting out of hand, and they're running into a potential problem. This is a good way to consolidate, get rid of that debt, and again, have the flexibility as to how you pay it back. You may want to buy, if not an ADU on your own, build an ADU on your own property, buy another property as a rental, again, to generate that rental income. This is a good way to do that. Maybe buy a 2, 3, or 4 unit property and get that rental income going to help build that wealth creation, even as you're a senior senior homeowner, and try to build more wealth that way. And then the last couple of things is you may just have a large purchase you need to make. Oftentimes that's related to home improvement. Maybe you need to buy solar and things like that. This is obviously a very good way to tap into that equity for that reason. And then the last thing is you may have a first and a second, but again, you're running into some issues with your income side of your equation, of your household. This might be a good way to get a home safe second, replace your existing second, and then that way not have to make payments on that. So you can free up your monthly household budget cash flow and be able to live more comfortably for those future years. And then, again, eventually, if you still have enough equity, we could look at doing a typical reverse mortgage, first mortgage later on, once you get past that 62 to 65 range. Again, if you still have that equity. So the point of this is you got all these uses for this product. And it's just a lot of things that people don't think about, but are available. And the rates on these are actually pretty darn good. You can actually get them now, like literally a little bit like under 8%. If you have a decent credit score, and again, you don't qualify through the same criteria. So it's a lot easier to qualify for. So I think it's a great product. Anybody who's 55 or older looking for a way to tap into your equity, give me a call. I'd be happy to give you a proposal about how this program works.
All right, I think that's fantastic. Just real quickly, before we wrap up, in that situation, how difficult is it for that homeowner to actually qualify for this loan?
Well, again, a traditional debt ratio is not the means for qualifying. Instead, what's the focus, or what can be the focus, is residual income based on your family size. And then what's really interesting is if you have a credit score of 720 or higher, the program is essentially stated income. You don't have to provide income documentation. Now, if you're below that, then you're in the second tier. And again, that credit score can go all the way down to 600. That's very good compared to a
Wow.
HELOC or a HELOAN where the credit score minimums are not anywhere near that low. You have to be much higher. So with this program, I've had many cases where, somebody comes to me and they're 58 and they want a HELOC, and I go through the numbers. Guess what? I can't do a HELOC for you. You don't meet the criteria. Your debt ratio is too high. But then I show them the home safe second, and they do qualify. So I can get them as much, sometimes more money, and then they have the added benefit of, if they were going to get a HELOC and make payments with home safe second, they can get as much, maybe more, and then make payments if they want, or not, or make payments at different times when it's convenient to do so. So it's just a lot more flexibility. I think overall it's a very good alternative. And in fact, in many cases, the best alternative for that profile of a homeowner.
I think that's great. It's I have to jump in here and give you a plug because Art, I know you took care of helping my wife and I secure such a situation, and yes, we did. We did a few things on our home. That was what we wanted to do. We're doing a little remodel on the kitchen. We put a new roof on the house, had the house painted. We're having solar installed, all because of the help of Art. So I know this is not intended to be a testimonial for you, but it is because it really made a difference of things that we could do. And you basically were able to help us unlock, a lot of equity in our home. So
Right.
Thank you. If you're out there thinking about this, hey, is this working for us? I'm a testament to that yes, it does. It's a great thing. And it just, all of a sudden, for me, I'll share this. It made it, and I'm a little bit of a penny pincher, is when it came to, writing the check for the house to get painted or the roof on there. It was so easy for me to write that check because I wasn't thinking, well, that's going to be another big payment, or there goes. It was such a relief, Art. So thank you.
Sure. Oh, you're welcome very much. Yeah. Happy to do it.
You bet. Well, I'll let you wrap up the show. Thank you so much. A lot of good information here, very valuable, and keep those things in mind. There will be a link in the comments if you'd like. You have questions about that. I know there was a little commercial that's in there, or a little information you shared us about that, and there'll be a link in the comment. Art, thank you so much.
Okay, thank you. Well, thank you everyone for watching this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works. I want to wish you a happy President's Day weekend, and even more importantly, have a happy Valentine's Day tomorrow with your loved one, significant other, spouse, etc. So looking forward to see you next week on the Mortgage Minute. Again, Art Alvarez with Mortgage Works, where we have the answers and they're on the house. So long. Take care.